What's up guys, Raymond here with episode 9 of our financial statement analysis videos for the German industrial stock sector, and we're going to be analyzing a stock called Frankfurt Airport. If you're new to my financial statement analysis videos, what we do in these videos is we analyze the top 3 financial statements that are relevant to a company, those being the income statement, the balance sheet and the cash flow statement, and we look at the key factors of each statement that determine the financial strength of the company in the past, present and future, and we attempt to, based on those pieces of information, determine or come up with an idea of how well the company would do in the future. So without further ado, look, we're going to start off with the key ratios. The key ratios will start off with the market cap. The market cap is the overall price of the stock, which is 4.24 billion euros, which is really good. The revenue figure is around half of that at 2.14 billion euros in the 2021 financial year. The PE ratio isn't available, and the earnings per share is negative 1.39 euros. What that means is the company earned a negative profit in the 2021 financial year of 1.39 euros per share. So if you multiply the 1.39 euros by the amount of shares outstanding, you'll get an overall idea of how much in total the company lost with regards to earnings. And with regards to negative earnings, it's calculated as how much the company spent versus how much the company made. So revenue plus expenditure. So the dividend yield doesn't show also the beta level, which is the overall risk level of the stock. So the risk associated with the stock based on the volatility according to an index or according to a market average of 1. The beta level was 1.55 up to this date, which shows that it's 55%. It's been 55% more risky or more volatile than the market average of 1. So let's get into the first of the income statement. So the first of the financial statements, which is the income statement. So as you can see, the company made a decent profit in the 2019 financial year, but made a negative profit in the 2020 financial year, which is actually quite a large amount of a large loss. So the company definitely spent a lot more cash than it made, so the company's revenue was also less than half of the previous year, and as we just said, the company managed to lose a lot of money also. So with regards to the revenue in the 2021 financial year, it managed to increase a little bit, but not quite the same level as the 2019 financial year. It hovered around half, 50% of the total revenue figure of the 2019 financial year, but the net profit figure or the net income figure ended up being positive. Although it was a small amount of profit that the company made, it was still positive. So the company managed to get back onto good ground in 2021 financial year. So when the 2022 financial statements are released, hopefully we see that the company's made more profit as well as more revenue. So let's get into the balance sheet, which depicts the company's liabilities as a ratio to its total assets. The total assets being the light purple figure and the total liabilities being the dark purple figure. As you can see, the both bars are quite close to each other, which means the total liabilities and the total assets are close to the same amount. I suggest a minimum, well, a good level of debt to assets is about 50%. As you can see, the company is way over 50% debt to assets in the graphs that you can see, but all three past financial years, which is not a good idea, because if you're borrowing cash from somebody or you're borrowing cash from a financial institution, you have to pay interest on the principal. So the more that a company borrows, so the more cash that a company borrows, or the more assets a company borrows, the more interest they have to repay. So whatever profit that the company made, and as we saw earlier, the profit margin was very, very small in the 2021 financial year. It was negative in the 2020 financial year, and was fairly decent in the 2019 financial year. The company will have to pay a portion of those profits to back to the creditors. So if the company is making a small amount of profit, then a large portion of that will be wiped out. So shareholders are going to be discouraged by the large amount of debt to assets. They call it being over leveraged. So let's get into the cash flow statement, which depicts how the company manages its inflowing cash, how it generates cash, how much cash it generates, as well as how it manages its debts and how it manages its assets. So we're going to get into more detail we're going to broaden this up. So we're going to check the 2021 financial year first. So the net income is the starting line of the cash flow statement, which shows that the company made 82 million euros in the 2021 financial year as net income, and cash from operating activities was 416 million euros. The cash from investing activities was negative 2.3 billion euros, but let's see how it got that negative figure. So it spent 2.3 billion euros on general general cash flow items, 1.15 billion euros of which was capital expenditures, so expanding the company's infrastructure so that the company can be more productive in the future, and the other 1.15 billion euros was spent on other cash flow items. So let's check the cash flow from financing activities. The company, it doesn't show what the company how the company generated money from cash flow items, but it does show that the company spent 2.10 billion euros eliminating debt or retiring debt, which is really good. It shows that the company's reducing its debt load, which is good. Hopefully it can continue this in the future, and if it's managed to spend a lot of cash on capital expenditures, hopefully it can produce a lot more output and use the growth in income to be able to pay off more debt and eliminate more debt, so the company can be less leveraged. So the foreign exchange effects, which is the result of the currency, which in this case is the euro, increasing in value compared to other currencies, was 7.6 billion euros, and the net change in cash for the 2021 financial year was 214.80 million euros, which is really good. Let's just check the net change in cash in the previous years to see how it's changed and whether or not there's any growth. So the 2020 financial year, the company had a negative net change in cash of 327 million euros. It spent 2.47. It accumulated debt in the 2020 financial year of 2.47 billion euros. And also its investing activities, it spent 1.12 billion euros on capital expenditures, and it spent 1.41 billion euros on other cash flow items. And 2019 financial year, the company had a negative 54.7 million euro net change in cash. So it's really good that it's got to a level where it has 214 million euros in cash in its books, coming from the previous year of having negative 227 million euros. So the company must have made almost 600 million and stashed away 214 million euros, which is really good. So without further ado, I'm going to close this video. Thank you for watching my financial statement analysis on Frankfurt Airport. Hopefully you're going to stay tuned for my next episode 10, in the financial statement analysis videos for the German industrial stocks. Thank you guys for watching again. I'll see you in the next one.